Um, yeah, my name is Anthony Kambiriri, and that's my profile. Sorry, I think there's a bit of a challenge in lighting from where I am, but hopefully we can communicate now. Oh, Kevin, yes. Hi, Kevin. You can say hello, Kevin.
Yes. Hi, everyone. Joined a bit late. I'm still on the road, but yeah.
Okay. Yeah. Thanks, Kevin. Thanks, Kevin, for joining. And myself too. Apologies for joining late. I think had another meeting that overran a little bit. Yeah. So that's fine. You guys want to learn about real estate, and I'd like to say, one of the life lessons of any investor is to continue learning. And there were a bunch of questions shared by Violet in terms of some of the things you'd want to understand, on real estate. But the interesting thing, just as a preamble, is even as we start the conversation, and we'll co-host with Kevin, in terms of any question, and feel free to put, more questions in the chat, even as we go along. It's to ask yourself, why real estate? So the first thing is that, real estate is the largest asset class in the world, by far. And even when you think about, everyone has a home, and especially residential real estate. Residential real estate within the sort of sector, the real estate sector is the largest asset class in the world. And when you think about, the people who have made significant wealth, what you would consider, your top 1% in the world. And I know Knight Frank just released a report showing, what is, being in the 1%, what it means in Kenya. And it means, someone who has a net worth of more than $20,000, which is about 2.8 million shillings. A portion of, their wealth is in real estate, yeah, in that way. So I think it's one of those, sectors that you cannot completely ignore, whether it's, it's your primary house, or it's also an investment tool, whereby you're earning income. So in terms of your total net worth, it's a very good sector to have. And realistically, even you look at the US, a lot of your millionaires actually have a significant portion of their wealth in real estate, whether it's their primary house or otherwise, in that case. So it's a very good venture in terms of wealth creation. And, it's something that should not be ignored. One of the other things to just understand is that, a well-built house can easily last about 300 years. If you go to, countries like the UK, you'll find, 500-700 years old houses. Yeah. So, and I was actually discussing with, one of my colleagues who is from the UK, and you realize that a lot of their stock, in terms of housing, residential housing, is it's pretty old. Yeah, so it's easy to find, a 150-year-old house and the like. And even something that is 50 years old not being considered as being very old, in that way. Yeah, so it's exciting that you guys want to learn about real estate, and I'm sure every one of you has a notion about why invest in real estate, and what are some of the key elements you'd look like. Yeah. But I don't know, Kevin, whether you can give a little bit of a preamble on why real estate.
Yes, sure. I hope everyone can hear me.
I don't know whether it's just me. You're breaking a little bit,
Hi,
but
Kevin.
I don't know.
No, yeah,
You can hear the
it's
bird.
choppy. No, it's choppy on Kevin's side. We can't hear you.
Hey, Kevin, I think you're
Hello.
dropping a little bit. Hello. Hi, Kevin. I think you're dropping a little bit. You're breaking a little bit. Yeah. I think he's dropped off.
Yeah. It's fine. You can just continue, then he will pick up
Okay.
from.
Okay.
Yeah.
I can pick up on one of the questions is, are the current returns in real estate beating inflation? The current inflation as at, the May report is at about 8.8%. Are the yields from real estate beating that inflation? So I think it depends with what real estate you hold. Yeah. I think, if you go to, your more affordable sector whereby, your units are well priced, you could get yields which are north of 8.8% in that sort of, general sector. And I would say yes. Yes. Oh, sorry, Kevin, you're back.
You can hear me now?
I think I can hear you. I can hear you. Yes. Yes.
All right. Sorry, I had to shift out of the location I was in. Hopefully it sticks. don't mind the Chinese woman. She's about to stop talking in a few seconds.
Okay.
Sorry.
Okay.
So
okay.
yeah. So my name is Kevin. Again, sorry. I understand my line was not very clear. I think somewhere in the building there's not network. But I was following on the conversation. So in terms of real estate, when you look at different asset classes that fall within the range of what an individual investor can invest in, you have a lot of different asset classes. And this range from whether you're buying stocks, whether you're putting your money in a SACCO, or whether you put your money in a bond, for those of you who've been investing in bonds. Money markets, you can trade in commodities. Now in the stock market, you can even do investments in gold. A big part of it depends a lot in terms of what you're looking for, especially in the grand scheme of what is your goal. Because one of the big challenges we have from an investment perspective is that a lot of people either invest blindly or invest as an afterthought. The big thing about investing is you first need to understand why you're investing. And if you know why you're investing, it becomes a lot easier for you to select which asset class you want to be in and how that relates towards that goal. A good example, can you still hear me?
Yes, Kevin, you're clear.
Okay. All right. So a good example would be, say you want to achieve retirement in the next 20 years. And therefore, the question becomes, what kind of risk do you want to take? Where real estate becomes unique, and I'm going to give you maybe an example relative to other asset classes so that it's easier for you to conceptualize. Today, for example, one of the things everyone is talking about is the government bonds. Last 2 weeks ago, the government did an IFB bond 7-year at about 15.8%. And of course, that's significantly higher than the returns that you'll make from real estate today, right? Real estate will probably have about 8, 9, 10% in terms of your annual yield. I'm hoping most of you know what a yield is, but basically it's the annual income you make divided by your investment into an asset. So if you get 100K every year and you need to invest 1 million shillings, then 100 over the 1 million gives you a yield of 10%. So when the government is giving you a 15.8% yield, it means for 1 million, you'll get 158K every year. And if you are to put that money in a real estate asset, you'll get 100K. So it's 58K less every year. And most people will get stuck only on that point. But one of the biggest differences with real estate compared to a bond, one is that when you get rent, the rent that most of you are paying today in Nairobi is not the same rent that was there 5 years ago. And it's not the same rent that was there 10 years ago. So unlike the cash flows from a bond, which are fixed over the entire duration of the bond, with real estate, your cash flow goes increasing, and this is driven by a function of inflation. So the rents will keep going up over time. I'm sure most of you already know this based on the neighborhood that you live in and experience based on the past. The other thing is that a bond, if you put in 1 million in a bond, 10 years from today, after you've earned all your income, you will get back just the principal value, which is the same 1 million. The value of real estate goes up over time, whether it's in property or it's in land. So that's the other thing to keep in mind. When you compare real estate to stocks, stocks have a lot of volatility. A lot of your pricing is driven by where the market is at different points in time. And also your dividends might come or they might not come. It depends on the performance of the company. And again, that's another distinction with real estate. But one of the things that I like about real estate is that one, your cash flows come in monthly. Secondly, your cash flows grow with inflation, which you don't have to do anything to get that increase in value. Your property goes up in value, and that doesn't require you to work for that either, right? It just goes up because there is inflation, and as a function of inflation, the value of the asset goes up. It's a very attractive asset when it comes to you using leverage, and this will probably be a much longer conversation. But your ability to take a loan. So if I give you a simple example, if today I bought a bond for 1 million shillings and I bought a house for 1 million shillings, and then 10 years from today, the value of my house has gone up to 2 million, but the bond is still 1 million. If I was to go to the bank for the house, they will give me a loan based on the valuation. So if it's worth 2 million and the bank can give you 70% or 80%, they'll give you 80% of 2 million. But for the bond, because your principal remains the same, you'll only get a loan based on that principal value. And those are some of the things that people don't pay as much attention to from a real estate perspective. Based on the new tax laws, it's also now cheaper from a tax perspective, because on your rental income tax, you're only paying 7.5% compared to your typical bond where there's a withholding tax of 15%. But that's part of the reasons to consider real estate usually as part of your investment portfolio. Kamau, I'll stop there.
Yeah, thank you, Kevin. Thank you, Kevin. And I think you've sort of gone very granular to help everyone understand, why invest in real estate. And I think you've also helped answer, the question on the current, returns in real estate, whether they're beating inflation. I think when you invest in real estate, it's a long-term play. I would imagine, you have the ability to sell the asset, in a couple of years' times, but you should always look at this, more from a long-term perspective. And the truth is, as the cost of living goes up today, because today the cost of living goes up, and actually the cost of building goes up. Yeah, because today you're at about, I would say, between 20 and 30%. The cost of building has gone up. And this brings a very interesting thought, that for you to own a house, 2 years down the line, it will be more expensive for you. So because of that inflation, in terms of things are becoming more expensive, so it lifts up the value of the already existing stock, because the replacement value for that item is actually higher. And also the rents also inflates with it, yeah, in that case. So over a much wider space of about, let's say, if you look at across 10 years, because also what we're hoping that inflation will not always be very high, then you actually realize that, if you look at your rental income growth, your capital appreciation, on the asset that you hold, then, there's an adjustment from an inflation perspective, unlike, any of the other fixed income investments that you might have in your portfolio, like government security, which are fixed on day one. And the other thing is that, in an environment where you have a depreciating currency, real estate holds off much better, as an asset class than most of your other sort of, things in your portfolio. It holds much better because that cost of replacement of that asset, as it goes higher, let's say a house today, you're building it with 1 million. If, in 2 years' time, it will cost you 1.5 million. So possibly the asset that was, 1 million shillings, because of time, it will cost you, 1.3, 1.4 million shillings, rather than, a new asset in that case. So, and, with any sort of, depreciating currency like we've seen in the Kenya shillings, it's always good to have real estate in your portfolio in that case. I don't know whether that has answered, the first question about are the current returns in real estate beating inflation? Sufficiently answered that.
Yes, we can move to the next one.
The next question is, and I'm conscious of time, so we'll try and bundle them up a little bit. And Kevin, possibly you can shed some perspective on, on rates, because we currently do have 3 rates in Kenya. So we do have the Fahari I rate, which is, the older one. And then we have the 2 rates from Econ, the development and income rate. Yeah. And I don't know whether you know what is an income, what is a development rate. Yeah. An income rate is generally a real estate investment trust, whereby they'll pull funds together from various investors and invest in an already complete building that has tenants. Yeah. And, the rental income that is, being generated from that house is then, in a way, distributed via dividends to the investors who have bought shares in that. So it's a way of, what I would say, demonetizing real estate, yeah, whereby, you can buy, a piece of an office that is in the CBD, or, you're part of, the student accommodation, student housing accommodation that Econ is putting into place. A development rate in the other side sort of gives you, it's a bit of a riskier vehicle because you're taking development risk when you put money there, but then you also get the developer's return, yeah, which is, is slightly higher than, the income, where, the risks are taken out and the income is in there in that way. And that's why you can see, that sort of VUCA Kwetu sort of platform patching up for, individual smaller investors coming into place. So one of the things is you realize is that, a lot of these rates are not well understood in the market, and that's one of the challenges they face. They're not very well understood in the market. And, if you look at, how the pricing is, versus, the price versus the book value, they're actually a discount, in terms of, where the book value is and where the sort of pricing is in terms of the share. And I think one of the uncertainties is, question around, the properly managed. One of the other questions is, they're not well understood. People still prefer to, buy assets directly in that way. But and I know Kevin has done this in part of his portfolio, in what he does in Brownstone, is whereby, we do have people who are sort of coming up with vehicles which are not exactly, registered rates, or, rates which are approved by the Capital Markets Authority, but for a bit of, you're more what would be called a sophisticated investor. I think the capital market defines that as an investor who is investing is it above 1 million shillings, in that case. But Kevin, you can give a little bit of some thoughts on what you see rates and where you see the future and sustainability of this.
All right, thanks, Kamau. In summary, a REIT would be just as Kamau explains, just your equivalent of a company where you're coming together. So it's the equivalent of shareholding. I think there was a question about whether it's different from shareholding. It's equivalent to shareholding. The only difference is the name that's given to the vehicle because of how it's structured. The REITs have a tax advantage because the income usually has less tax. It's an incentive to get investors to invest in it. But part of the challenges around REITs as well has been around how the regulations are structured. If you look at Fahari REIT, as much as it's trading way below the value of the assets, part of the problem is that if you look at the operating costs, they're quite high and a lot of them are based on regulation. So like the cost for them paying a trustee, the cost for them to have a REIT manager, the cost for them having a valuer who has to do valuation every year, a property manager who's approved by CMA. And those tend to lump on a lot of costs so that at the end of the day, the dividend yield that you get from the REIT, it's actually fairly low. And that's why you'll see the prices will trend down. So an example would be for Fahari REIT, which currently has assets worth 3 billion, has a market capitalization of around 1 billion. But if you look at the dividend that they pay at the end of the year, that usually gives you a yield of around 10 to 12%. And that's why the price sort of has adjusted to come down. Whether it's a good investment, yes, it is, just mostly because if you're a passive investor, it gives you a good way to get passive income. But one of the things that you'll need to remember is that you'll be dependent on the market for you to get any upside. So unlike in the case where if I bought an apartment today and I want to sell it 10 years from today, I will just pick the price in the market at that point and sell it. For this one, it's slightly out of your control because you'll have to hope that the share price does go up over time, which it should for the case of the REIT as well. But that depends largely on how the property is managed and their capacity to increase rental income.
Yeah, thanks, Kevin. So, I know when you think about a rate, there are people who've done this a bit differently, whereby, like what we've done in our with a group of friends, whereby we came together and put together an investment group, and we have, which is a corporate entity, it's a company, whereby, we are all shareholders in there, and we go and buy land and build and invest and get rental income from it. It's a similar structure to a REIT in that way, such that, you're a shareholder who's getting some dividends from the rental income. You're in a bit of a smaller group and you have a bit more control in that essence. So it's, you don't have all the complete tax advantages that a REIT has. But then you're closer to the money, in terms of distributions. And, it's one of the ways that chamas and investment groups have been able to sort of get around and still develop something. Because if you look at sort of the assets within REITs, they are more corporate. And, as Kevin has mentioned, there are a lot of costs associated with that, both from an operational perspective, but also from when you're building it. Yeah. So you do have, a lot of cost that goes into it because you need to ensure that asset is right, is investment grade. And because it's a larger asset, in this case, you have to do it in that way and you have to do it right. So I think that's the other perspective whereby, people can pull funds together and you're actually able to invest in real estate on the shareholding side. And I know that's one of the things that, yes.
Don't you worry about us. Everything's under control here.
Yeah, Anthony, you can continue.
Okay, no problem. So I think one of the third question was, is buying a property off plan best funded through savings, income, or a bank loan? And then the other question was pros and cons of paying cash versus loans for a developed property. And then I'll combine it with the question about how can an investor minimize risk on off-plan purchases. Yeah. So I think this deals with, off-plan and debt. And I know there's the other question about KMRC. I think we can take those together, in terms of off-plan. And I don't know what, the various people have experienced in terms of off-plan purchases in this group. And historically, in Kenya, we've not had a very good track record with, some of the developers who have done this, not really doing very well. Kevin, would you like to take a stab on this at first?
It's a bit broad. Maybe I'll just talk about the off plan. In terms of the financing of the off plan, you need to start off, I think, by looking at the level of risk that you're assuming, right? When you're looking at your off-plan investment, as Kamau has mentioned, one of the biggest risks is that some of the developments have not been completed on time. So, of course, if you finance this through a loan, then you end up with a higher risk. Part of the advantages of off-plan is precisely the fact that it allows you to pay slowly over time. So it allows you to not take this big amount of money at once and put it into something where you're paying for a loan, but you're not getting any rental income as a return. Now, if you compare it to when you have a building that's already built, it makes a lot more sense for you to go take a bank loan and then pay for it, and then you can be left paying for the loan. But with a lot of these off-plan developments, the point where it makes sense to probably take a loan would be towards the tail end once the investment is closer to being finished, because at that point, it will make more sense for you to have a loan and then use part of that rental income to offset your payments towards the loan. So that's what I would say from that perspective. But in the as a disclaimer, where Kamau started, the first thing, if you're going to be a real estate investor, is to keep in mind that you have to play the long game. And if you're looking at it from that perspective, then over a 10, 15, 20-year period, it really doesn't matter how you finance it. As long as the off-plan development is complete, one of the big advantages you'll have is that with the off-plan development, you have a higher potential for capital gains compared to when you buy one that's already completed.
Yeah, thanks, Kevin. And the question that follows up is after that is, how can an investor minimize risk of off-plan purchases? So a lot of times what happens with investors is that they don't do their due diligence. And, in terms of what you're hearing outside there and what's really on the ground. And one of the things to sort of minimize this is to do due diligence. And your due diligence, is, I would say, in 3 levels. One is what's the track record of the developer? Have they built? What have they built? Have you gone and seen and touched what they have done in that way? So the track record of the developer who is there. Then, and in doing that track record, what you can do is, if you have someone who is a previous buyer, into one of their projects, just independently understand that. Then the second thing is, your legal due diligence in terms of Does the developer own the land that they are claiming to be building on? Because it's very easy for someone to go and show you bare land and tell you you're going to do this, but you realize that actually that is not the case. That is not the case, and the story behind it is not very clear. It's not something that you do understand there. And it's always good to, in some of these cases, to involve a lawyer who will be able to, help you, just sense out and understand, where are they, on that process. Then the third level of, ways of sort of minimizing risk, I think, is what Kevin has said, that you sort of, a lot of off-plan, developers have an installment plan, yeah, whereby you're paying, let's say, 20-30% on day one or thereabout, and the rest over time, yeah, such that you're not necessarily exactly offloading all the amount on day one, but you're able to visit the site, see what's happening, on that way, and that gives you a lot of confidence in terms of the project you're buying into, how it's going on. Because sometimes you do find investors who buy into a project, they have never gone to visit the site, they have never been there, and there are no updates being given by the developer, in terms of how the project is going, and then they're just sending money. So I would say those are sort of some of the ways to sort of help minimize risk. But one of the things I've seen is that, on an off-plan development, there's definitely a higher risk than, when you're buying a complete property. Just also when you're buying a complete property, there's still some risk, but, there's definitely a higher risk. There's an upside in terms of, capital gains. There's an upside in terms of you don't necessarily need, bank financing, because you can find some of these things are bespoke, and you're able to sort of, over time own the assets in that way. But it's also good to invest with people you feel a bit comfortable, because one of the things I say, which is not exactly, logical, is there's always your gut feel on things. Yeah, there's to understand your risk appetites, but there's also your gut feel on things as you meet people and interact with the sales team and the developer. There's where you go and you feel from the people I'm talking to, correlated with the sort of due diligence I've done, and not just due diligence from a lawyer, but you're looking at other projects, you're possibly talking to people who've bought with them before. It creates a bit of it creates a bit of confidence, because one of the big challenges with developers is when they mix funds between projects, and that's usually sort of what I would call the poison pill of developers, whereby they expand too fast and you start mixing funds between developments in that way. And it's just sort of good to understand, even from a conversational level, how that is working in that way. I know, myself and Kevin are developers, in a sense, or we are investors in the real estate sector. And actually, that's one of the things that we are trying to sort of cure in terms of bridging that trust gap, yeah. Because you have had developers who have mismanaged people's money in the past, and everyone looks at an off plan like, you're going to lose your money in that case, and it becomes a very difficult thing to sort of deal with. But I do think there are also developers in the market who have, they might be a bit, newer, or even some of the older ones, but they have a good track record and they do deliver to their promise. So sorry, Rhoda, I can see it's like you wanted to mention something or ask a question.
I'm not sure she wanted to ask a question.
Okay, that's it. So but I think the other question is pros and cons of paying cash versus loans for a developed property. I think in the long term, if it all works out, it's usually okay either way. But my personal view on debt is that you should take a very calculated risk on debt, yeah, and ensure that whatsoever sort of debt that you're taking for any property, you can sustain it, yeah. Because think about it today, you're not in control of what the bank will charge you as interest rates. Today, Equity Bank just increased, they have just increased their base rate, yeah. So and that means that you do have more interest, yeah, coming up, yeah, coming up. So there are also risks, in terms of taking debt. But I always say, if you can take some manageable debts and you're not overly aggressive on debt, then you're able to balance it over time until you sort of build a portfolio that can work much better. Liz is asking that, I've heard this bit being mentioned, correct? The off plan in the long term is better than buying property rental that's completed due to cost. Yes, that's the truth. The truth is that, like for the project that we are currently about to finish, which will be finished in another 2 or so months, we're selling our 1 bedroom at the initial price was about 2.8 million shillings. And completion, that 1 bedroom would be about 3.5 million shillings. So there's definitely a capital appreciation on that unit. If you also look at the yield that the person who bought it at at 2.8 versus the person who will buy it at 3.5 will get from that unit that they buy, the yield at 2.8 is much higher than the person who's buying the the unit at about 3.5 million shillings. So the thing is that you're also taking a bit of risk, yeah, because returns are always looked together with risk, yeah. That you're taking a risk on the developer, and you're taking a risk that this person is going to complete the project, yeah. So it's a bit on both sides. You're taking a leap of faith on one side and taking some risk, but for you to get higher risk, for you to get higher returns, you must be willing to take a little bit more risk. And I think depending on your risk appetite, yeah, and where you are in the curve. And one of the things, I do know that most of you are a bit, younger. When you're younger, and it's better to take a bit more risk there. Then as you grow older, you can then taper it down a little bit. No, it's not always the case, but that's usually sort of your general sort of rule of thumb. But it also depends with as Kevin mentioned, what are you investing for? Then that really helps sort of calibrate what sort of risk level you should be taking. But the general rule of thumb is that if you're younger, you can take a bit more risk because you do have a bit of more time to recover. How can one access KMRC affordable housing mortgage, and through which institutions, and what are the limits? Can the mortgage be used for construction, or it's already for finished units? Just to mention this, the KMRC deals with finished units because it's a mortgage. Yeah, it's not a construction loan. Yeah, so it's a mortgage. So generally, they have partnered with a couple of banks. Your bigger banks like KCB, Stanbic. There are some circles who are in there. If you go to the KMRC website, you're able to see who are sort of who they have partnered with. I know that that currently, I think the maximum limit for the sort of loans they're giving to individuals is up to 8 million shillings. So you can get a loan of up to 8 million shillings. And for the various banks, depending on what sort of spread they're applying on the money they're getting from KMRC, you generally get a loan that is single digit. So you can get, at best, I think what I've heard is 8%, possibly there's 9.5% here. But this is on a completed unit. In that way, yes, you can definitely buy a higher value unit than that 8 million shillings. But the maximum, in terms of the loan amount that you can get, under the KMRC arrangement, which is the Kenya Mortgage Refinance Company, is a max of 8 million shillings. There are a few hoops to jump with the various banks, but that's the sort of arrangements there. The other one is and possibly, Kevin, you can take this in terms of the rental income tax, because you have touched on it. It's currently been dropped in the new finance bill to 7.5%. It was previously 10%. This is on gross income, and one of the things you realize, that is skewed a little bit, especially on residential, is that it's on gross income, but it's actually much cheaper than if you were to sort of deduct your any expenses which will be allowable and pay 30%. So, and I think the reason they're doing this is to try and encourage a lot of people who have rental properties to sort of come into sort of the tax net. And one of the other things is because you are not allowed to deduct your capital costs, especially on residential development, from the income you're getting. I think the only thing you're allowed to deduct is any sort of repairs and maintenance and any sort of direct costs associated with this, such as interest expense, if you want to sort of go through the 30% route. But having done those maths, the 7.5% is usually much less for this sort of housing in that case. And as Kevin mentioned, if you're buying a bond, you are withholding 15%. If it's not an infrastructure bond, if you're putting your interest in a bank or in a fixed product, you're getting 15% off the top, of the income. So this is a much better incentive for people to invest in real estate. Number 8 is, how do you estimate rental value in a given area? I feel developers exaggerate how much people will pay rent in some of those areas. Kevin, would you like to take on that one?
Yes, I think that one is a fairly easy one. Always, before you buy a development in a given area, just take 2 hours to walk the area. You'll actually be surprised by how much you can learn about an area by just walking around and asking the caretakers, the tenants who live in an area, how much rent they pay. I believe I also speak for Kamau. When we are designing our projects, one of the first things we do is to walk around the area to look at the size of units, the quality of the finish, what rental rates are people paying for your potential tenants. So if somebody is promising you in an area that they're going to do a 1-bedroom for 16,000, and an average 1-bedroom in that area is 10,000, the question you should ask them is, what amenities are you doing that justify the much higher rental, right? Or provide me with your finishes schedule to show me how much more you'll get. But even beyond that, sometimes people end up overspecing the development that they do, there are certain areas where even if you did wooden floors, the tenants would not be willing to pay you that much more than what is in the market. So the simple answer there is just walk the area, look at the kind of developments in the place, and that should give you an indication in terms of what's reasonable rent for that location.
Okay. I think the other question was, how do we calculate returns on rates? I think Kevin mentioned what that is. And then the other one is how to legally evade tax on rental properties. I think there's what we call evasion and there's what we call avoidance. Yeah, in this case. Yeah, given that your rental income tax is 7.5%, my advice would be just comply, with that, because the truth is that over time the government is just going to get people in the net because they're currently very aggressive, and they're going to get there, and because it is off your gross rent, 7.5% of your gross rent. It's much easier than any other form, because what primarily people had done in the past is to try and, put everything, including the, you put all costs, to try and reduce your income and then apply 30% rule. So even if you were to get, let's say, 40% of your income, those are costs, and you're remaining with 60%. 60%, if you multiply by 30%, is still much higher. It's about 18%. It's still much higher than if you were to pay 7.5% of your gross in that way. So there's a bit of more tax planning for more, sort of complex vehicles to be required. A bit of more tax planning if you're investing in commercial real estate, because commercial real estate, thereby where you're charging VAT and everything else, you are allowed to then have, your capital investment as an allowance that you can take off over time. But that's a bit for, more complicated and, bigger ticket prices on that one. Today, I would just say, these guys are going to catch up, and one of the ways they're doing this is that, as long as you have a meter registered in your name, they will find you. It's just a matter of time in that way. So any reputable companies offering off-plan real estate with proven track record in Kenya? Kevin.
Sorry, Kamau, I didn't get that part.
Do you know of any reputable companies offering off-plan real estate with proven track record in Kenya?
Well, that's a tricky question when you're conflicted, but yes, I can mention one, the most famous one currently, I think, is Savo Properties. There are a lot of things you have to balance, of course, when you're looking at your real estate and sustainability and long-term. So I and Brownstone, we do the off-plan investments. So far, we developed probably over 600 apartments, all completed on time, but we try to ensure they are smaller sized projects. Reva, I've actually invested with Kamau as well. His units are probably better than what I can develop, and a lot larger in terms of size than what we do. And I think currently, Kamau, you're still on schedule to complete. There are other companies, I don't know if I want to mention them as reputable, because in terms of completion on time, they have, but the only problem is the post-construction management, and that's probably one of the key things I'll advise looking at the off-plan project.
Kevin, we lost you.
Oh, sorry, Kevin, we lost you, yeah?
A lot of them currently are structured in a way where you do, and the thing about real estate is it goes beyond just the construction, so that it doesn't deteriorate. Oh, at what point did you lose me? Hello?
I think we've lost you just like a minute ago. Yeah.
Can you
So
hear me
I
now?
think when you're, yeah, we can
Okay.
hear you. We can hear you now. Yeah.
At what point did you lose me?
About a minute ago, and you're talking about whether you'd like to mention some of the other guys who've completed on time,
Okay,
but
sorry.
the
Yes.
real
So
estate management.
one of the big things about real estate that you learn over time is that the biggest part about real estate goes beyond the construction, and it's about the post-construction management. As an investor, one of the things that you want to look out for is somebody who will do good post-construction management. So some of the ones, I will not mention the names, is that as much as they complete their project on time, they don't do very good post-construction management. So the problem with that becomes that sustainability in terms of your ability to maintain high occupancy becomes a bit of a challenge. So that's one thing to keep in mind. And this is assuming that you're looking to buy the real estate as an investment. However, if you're buying one as a home, this becomes even more critical. A lot of developments in the country tend to fail post-construction because you all bought houses together in this development where the developer left, and then you're supposed to be organizing yourself within the context of managing. You find some houses people don't want to pay service charge, and this is a problem. You'd be surprised even in the posh estates. I have investments in areas like Kileleshwa where it's impossible to get certain people to pay their service charge, and what happens over time, the quality of the development just goes down. So keep in mind that when you invest in a development, the contractor or the developer has created enough structures for the post-construction management, because things like boreholes die, borehole pumps die, lifts fail, and at the end of the day, you need to figure out a way around how you solve for such things.
Yeah, thanks. Thanks, Kevin. Yeah, and I think you've struck the nail on the head when it comes to post-construction management, and some of the people in the sort of field who are doing this. Yeah, you do have some of the other sort of reputable developers like Mivida, who are well backed, and they're selling quite a bit of units in the market, and the like, and they have a good track record on that case. So I think those are the most of the questions that we had, in terms of just getting around real estate. I know there's someone who's asked, is there any tax advantage to having rental property and a family trusts? I think a family trust, in terms of tax advantage, not exactly in that way. I think a family trust just helps sort of ensure longevity of the assets which are held there, because they're not left to an individual, and there are some sort of rules governing the putting up of the trust in that way, such that someone can't sell. Because if you transfer assets into a trust, then there are trust managers who come into place, and it's a lot more difficult to sell. And I think that's more used from an inheritance perspective. You don't want that the people who you have left the units to just wake up and say they don't like Kenya, and they sell everything that they have, and you don't know how they're going to manage that. So I think the only tax advantages is when you're putting together a trust, there are some exemptions in terms of things like stamp duty and putting those assets there. And then, in terms of succession of those assets with people within the trust, in that case. But in terms of, an income coming into the trust, you'll still be expected to pay your rental income tax in that case. I don't know whether that has clarified a little bit about, that question. But I know our time is far much spent. But what I would say is, you guys have done a very nice course with Investable, and I know Rina, and I've engaged with her, quite a bit on other areas. The most important thing is, you know, especially in real estate, and especially for you, is that, you know, a lot of times, you know, what I'm finding the challenge with younger people is analysis paralysis. Yeah, you can spend time analyzing investments, but you never act. Yeah. you, you, you never act. And I think an important point is to actually act and get yourself into something. Yeah. Because as I mentioned, starting off is that, you know, any person who is, you know, if you look at across all millionaires in the world, a portion of their wealth is really held up in real estate. So, you know, if you've not started on that journey, get on the bandwagon. We are not saying that, you know, you have to buy from Brownstone or Reva in this case, but we're just saying it's one of the best ways of, you know, wealth creation in that way, and especially when you think about passive income, because one of the most important things that you can ever sort of create as a person, because there's an old Rhoda, there's an old Samuel, there's an old Samson who's depending on, you know, the investment decisions that you're going to do today to live off on, you know, 40 years from now, yeah, or 30 years from now. So, and one of the things you realize that's really helpful is, you know, when you create an income flow, passive income. And one of the interesting things we've seen with some of our investors in the project is someone who's saying, you know, they want to get into a place where they can get, you know, 50,000 or 100,000 as passive income, yeah. And they start through this journey of, you know, buying, you know, a studio apartment that will give them, you know, 12,000 shillings, yeah. And after they do that, you know, in their second year, they also, you know, buy another one and buy another one and buy another one. And across, you know, 5-7 years, you find someone has reached that goal. And Kevin, I know, has done some very interesting maths, you know, in terms of, you know, the compounding nature of creating passive income, even from a real estate perspective. That is what people don't look at, because I think investments is more, it's more behavioral than intellectual. Yeah, if you really want to make money, it's more behavioral than intellectual. It's not, you know, how smart you are from an IQ perspective. For a lot of people, it's more of the behavior that you set into place and the precedents that sort of follow after that. But Kevin, I don't know what you'd like to sort of give us some real life examples, you know, in your interactions, you know, with the various investors who are sort of making strides. And let's not talk about, you know, the big old time investors like, you know, the Kenyatta family and the like, but, you know, people who you know, Rhoda, you know, Esther can relate with. Yeah.
Yes. So I can give maybe an example of our typical investor in Brownstone. Kamau mentioned something very important. One of the big challenges I realized with real estate is people don't start. So most times people are driven by fear, and then they don't ever make the investment. The beauty with things like the off-plan investments is just that discipline that it creates. If you know you're going to buy a studio from Kamau or from whoever you're buying from, and you're going to be paying 100K every month, that consistency is what builds you over time. And one of the things I tell the investors we have is that the path to wealth is actually a very slow boarding process. It's equivalent to a standing order. So if you look at our typical investor, we speak to lots of different investors, and our goal is always, we're telling them, even if you assumed you want to buy one studio every year for the next 20 years, and somebody else is going to put that same 1.5 million into land, over a 20-year period, you put in 1.5 million, 20 years down the line, you'd have invested 30 million shillings in land. And that land will definitely go up in value over time. But the difference is that somebody else who chooses to instead do studio every year, and they're going to put in the same 1.5, is that the funny thing is that
You're breaking up.
the end of the 20 years, if they're we'll actually end up with something closer to plots of land somebody else has bought. Again. Now, is that better?
Yes.
Okay.
I think
So
it's better.
I was
I think you can
giving an
repeat a little
example.
bit.
Yeah, I'm going to go back to the example. So the example I was giving is you have two people. One person decides they're going to be buying land. The other person decides they're 1.5 million shillings, right? So if you're putting 1.5 million shillings every year into land, over a 20-year period,
We lost you.
1.5 every year. I don't know how come I'm getting lost.
We
Can you hear me
you
now?
can. Yeah, I think we can hear you now. You can hear you now. Yeah.
Okay. I'm also happy to share a working in case I get lost. I don't know why the network is a bit choppy.
Yeah.
I was giving the example of the land. If somebody is buying land worth 1.5 every year for the next 20 years, they would have invested 30 million shillings and will be owning 20 plots of land. If somebody else is putting in money to buy a studio every year worth 1.5 and reinvesting the rent they receive from the studios that they are buying, at the end of the 20-year period, they'll have something closer to about 40 studios. And that goes back to the power of compounding in terms of when you invest in the property, if you're going to eat your rent, then you're actually not doing yourself any favor. The biggest favor you'll do yourself is by actually reinvesting that income towards building more studios. Our average investor in Brownstone, who started with us 5 years ago, through investing an average of about 150K to 200K a month, is now making a passive income of about 100K every month. Now, if you look at 100K every month in a year is about 1.2 million. This can help them quite a bit in terms of the subsequent investments that they make. And the more houses they keep buying, the more rental income they build up. So very easily over a 20-year period, this is somebody who will end up with anything between 800K and 1 million shillings a year in terms of rental income. Initially, it doesn't usually sound like much because you're putting quite a huge amount of money and your rental income streams in slowly. But if you reinvest that income, it builds up quite fast and quite significantly. Maybe one of the quick example I can give you is of this lady who had a very high saving rate. She was earning a net income of around 450K, and she was investing around 350K every month in real estate. About 3 years later, she had built up enough units to give her about 180K a month in rental income. And what happened is that she lost her job. So what she did is she moved into one of her units, which reduced her rent slightly, but she was still making about 140K a month. And she's actually not gone back to employment for almost 2 years. She decided to take that time off work to figure out herself and to figure out her way forward. But this gives you an example of what that passive income can do for you, even in terms of the decisions and the freedom that you get in terms of how you operate your life.
Thanks, Kevin. Thanks, Kevin. I think that's a very vivid example of what it means to have passive income, especially when life happens. But anyway, I don't know whether there are any questions, Violet, or any questions from any one of you, because I think we've come towards the end of our talk and some of the questions you had sent. But I don't know whether there's anything from anyone. So feel free to put it in the chat or put it in the mic, or is there anything, Violet, you'd like us to shed some more light on?
I have no question on my end. I can't see any question on the chat box. I'll give it a minute for anyone who has a question to unmute their mic and ask. If none comes through, we will end the session. Okay. I assume there are no questions. Anthony or Kevin, do you have closing remarks?
I think I can give Kevin then.
Sure. I think the only thing I will tell you is the hardest part about investing is the starting. But once you start, the rest of the path becomes easy. Consistency will probably be one of your biggest friends in terms of you reaching your financial goals. So at the end of the day, regardless of which asset class you choose to invest in, as long as you maintain discipline and consistency, you predestined to make it in the long term.
Kevin, someone is requesting that you share the worksheet on real estate investments.
Yes, I will share the worksheet on the calculations between somebody who is buying land and somebody who is buying income earning asset.
Okay, one question has come through on the post-construction management. Which steps can one make to ensure you are airtight when choosing a developer?
I don't know. Anyway, I can pick it and say, I think, one of the important things is to just understand if the developer, using whatever vehicle they are having, whether they intend to offer post-construction management. And I think one of the things that Kevin and I are very clear on is that we like offering that post-construction management as part of our value add to the investors who buy with us. And one of the other things is that we also retain units in sort of the units, sort of the developments that we built, and that ensures that there's considerable sort of interest post construction in that way. So I think those two things, when you have someone who is retaining some interest in that development, and also they offer it as a service, that really sort of helps. I can see GW asking, is Savo expanding too fast? Kevin, is Savo expanding too fast?
That's an interesting question. Let me put it in a different way. One of the things I am a very big believer in is managing growth relative to risk. The problem with risk is not something that you can easily control for. So all I'll leave you with is usually a very good example. If today the dollar went up to 200 shillings and therefore the cost of steel and cement doubled, how much risk would you have to carry as a developer? Because one of the biggest risks that we carry as developers that probably most people don't see is that usually we sell out most of our developments way before we even are midway through the construction. So you already sold your asset at a fixed price, but your cost is a moving target. So the challenge is always, if I'm doing 100 units and costs went out, as a developer, I can go to the bank and take a loan and finish the building, make a loss, but my loss is based on 100 units. If I start moving to the point where I'm doing 1,500 units and the similar risk was to recur, we'll be talking about billions of shillings. So it's not necessarily an issue of whether you're growing too fast. It's just whether you have sufficient capacity to be able to cover shocks that happen in the market, because shocks are not things that you have necessarily control over. They just happen. And when they do happen, you need to be in a comfortable position to be able to handle them. I hope in a way that answers the question.
And to piggyback on that, one of the things that gives me a little bit of comfort on Savo is that they're not heavily geared. I think the last time I spoke to someone within, they don't have any external debt. In that way, such as they have built quite a bit of trust. I'm not saying that I'm endorsing them, and if something happens tomorrow, someone says, Anthony said. Yeah, but the risks in these markets are real, and you can see what's happening in terms of inflation, and that could as well become quite difficult. But it also shows you that one of the other things, the reason they're growing this fast is because they are tapping into a market which has not been served, which is sort of the same market that me and Kevin play in, but offering different products and smaller projects, which I think are they're much better to manage in the long term. Is that they're serving a market that has not been addressed for a long period of time, and this is our young people, or in that case. But as to whether they have good governance structures, because growth needs to be managed both from a governance perspective, both from a cash flow perspective, both from from many other perspectives, from shocks in the market, external shocks, in that way, whether they have the right sort of model. We are in a very fast changing market, yeah, and things could happen that will be very different. But one of the things that encourages me is that they don't have any external debts. Money.
Yes.
Yes, Money. I can see your hand is up. Yes.
Yes. Thanks for taking my question. I missed some of the presentation, but I caught brief parts of it. Yeah, just first comment. I'm hoping nothing happens with Savo because I'm in there. But second question or comment would be, I think you had talked about due diligence when it comes to off plan. I think from my observation, I think like just off plan, like I mean, what I've seen is just go in there knowing that it's high risk, because it's easy to laugh at the people who maybe like like lost out, or like their money disappeared. But even in my particular case, I did what I thought was due diligence. The reputation of the company, like seemed to be good. The track record seemed to be good. And here we are, like luckily, like I think the project might be saved, but it's been what, like over 6 years. But luckily, I think there's some light. We might still get something out of it. But yeah, I guess for me, I would say like what you were saying about due diligence. Those things that you had mentioned, I feel like we did all of those, and yet uh, things still fell through. So I don't know. Yeah, it's just a comment.
Yeah, noted Money, and I think I sort of also mentioned that there's risk in all these things that you're doing. And I think if you're seeking a higher return, so you have to take a little bit more risk, in any way, whether you started a business and or you did telephone farming, like I've done in the past, and those kind of things. There are always risks to anything. I guess the question is how do you try and ensure you are trying to minimize the risk? You can never fully eliminate, but there are people who invest without even doing any due diligence, just because their friend has bought in, yeah. And some of them it has worked out, yeah. As long as the developer who you are developing with is fine, because like one of the unfortunate things you realize is that with things happening in the market, they have affected developers, yeah. Especially when you have a developer who's heavily reliant on the bank, yeah. And interest rates go high, there was capping in the market, things happen, and you realize you undergo a sort of a freeze. And sometimes even for developers, it's sometimes even in no fault of your own, yeah. Possibly the intention was to actually, do everything that you needed to do to get it done, but there are factors which are outside you, outside your scope. Yeah.
Yeah, I just wanted to maybe just to add that in our case, what happened, the developer just disappeared. And luckily what happened, the bank has agreed to take over the project. So now hopefully it should be completed. But, like at some point we were just thinking this is imeenda. Yeah, so hopefully it's light at the end of the tunnel, but yeah, it's just a comment. But
Yeah. Wish
yeah,
you all the best, Manny. Wish you all the best. Yeah. Wish you all the best. Yeah. Okay. Thanks. I think thank you, everyone. I think my final comment is, as I mentioned, investment is more about behavior and consistency than anything else. Than even sometimes picking the right horse. Yeah. Because sometimes you can pick the right horse and jump off at the wrong time. Yeah. Yeah, but it has, I think Manny has mentioned he's been into one which has not worked very well, but he's investing with Savo, and it looks to be going much better. So it doesn't mean that if you do something that it doesn't work the first time, that you should stop doing it. Yeah. Sometimes it's just recalibrating and learning and moving. The game of any investor is to look at risk and decide what to do. In terms of
but
managing that risk and investing. Yep. Thank you very much, Violet, and
Maybe
thank you
one
very much,
question
everyone.
before you go. Anthony and Kevin, one question before you go. If
Yes.
any of these people want to start investing right now, do you have sites where they can look at or anything? Do you have current investments which they can look at?
For me, yeah. For me, we do have our current project that is ongoing. It's called the Aviv, and I'll share with you what the site is. This one is fully sold, but we are launching our next project towards the end of this year, which is called Miaka. And happy to share and happy to even host the group for a tour on the current project, and even to tour Kevin's project. I think Kevin has an ongoing project in Muthaiga called Amazaya. It's on Wayaki Way. Yeah? It's called Amazaya DMW, and there's still some available units for sale there. On his current project. So we do have some things in the pipeline, and we do have some things which have already been done. What I can do, Violet, is that I can share with you links to the brochure and our website. Then happy to have anyone reach out to to myself or Kevin in case of in case you're thinking about investing.
Okay. Thank you.
Yep. Thank you.
Okay, thank you so much, Anthony and Kevin. Thank you all for joining. I think that marks the end of our session today. Good evening. Bye.
Okay, thank you guys. Thank you.